guest on the show, Mr. Ayodele Akinwumi, who is the head of research at FSDH Merchant Bank. Thank you so much for joining us on Capital Market this evening, sir.
Thank you for having me.
It's really good to have you on the show again after a long while. So let's start off with this bond auction that took place this week. What can you tell us about the subscription rates that we've seen and the fact that we had the rates coming in at 13.5% almost across board?
Thank you very much. Thank you for having me. Yes, the bond auction was successful, largely successful. However, we noted that the yield this time was higher than what it was the last auction, last month of April, and largely in line with our expectations.
Why was that?
We had thought that because of the drastic drop in yield on fixed income securities in the local market, yes, inflation is dropping. We've seen some little stability in foreign exchange market. But then if you look at the external environment, the international market, yield seems to be going up at the international level. Even the Nigerian government, federal government, Eurobonds, yield are beginning to trend up. Just because of the monetary policy normalization that we're beginning to see in advanced country because of the improvement in their economy. FOMC, yes, met in May, but they kept rates. They are going to meet in June. The expectations in the market is that they may likely increase rate. And as they begin to increase rate this way, then the yield on fixed income securities begin to go up and they begin to be more attractive. And therefore, as federal government begin to adopt its strategies to lower the subscription level, the issuance of debt at the short end of the market, and move some money to the long end of the curve, which is federal government bonds, and to fund the budget. The budget has just been passed by the National Assembly this week and transmitted to the president, as we heard yesterday. They will begin to spend, and therefore yield at that end may begin to go up. And they will need to manage the economy in such a way that they will need to still make this instrument a bit attractive for people, because we don't have all the money that we need to spend in the local economy.
So investors now should trade off that fears of a single-digit yield as that fear set into the market earlier.
Well, I think the structure of Nigerian economy today and the economic fundamentals which need to be in place for you to discuss how much money, how much rates are you going to borrow your instruments. I do not think for federal government bond that we are going to see single-digit yield given the current economic fundamentals in Nigeria. We still have, foreign exchange is dominated by oil, foreign exchange earnings, and then we have interest of foreign investors who bring in money, even though that's not the only source of foreign exchange earning in Nigeria in terms of the foreign portfolio investment here. Now, they will need to see how they manage their expectations. We have, if anything happens to oil price today, oil production, there will likely be a lot of problems in the foreign exchange market. Therefore, we need to see how they need to continue to make some of this yield attractive for all the players in the market, both local investors and foreign investors. And more so, as the yields in international market begin to go up, funds are looking for where they can have good, risk-adjusted return. And when you have a global market where there is free mobility of funds, they will move to an area where you have good yield, given the same level of, risk trade-off. So that's what we are likely going to see here. But the federal government has done well. The Debt Management Office has done well. Last year, yield on federal treasury bill went as high as 23%, but now it's in the region of 11%. Good enough, allowed private sector to banks and other corporate to go and issue commercial paper, bonds, in the corporate bonds in the market. But then they need money. Look at the 2018 budget that has just been passed by the National Assembly. We have almost 2 trillion budget deficit. That money has to come from somewhere. So if you need to borrow, is like you in economics, you say when you determine quantity, you don't fix price. So you can't fix the two at the same time, quantity and price. So once you determine one, you allow the market to fix the other one. And the market will have to take into consideration your fundamentals, your interest rates, your inflation rate, exchange rate, for them to determine the yield at which they should be pricing your instruments. And that's what I think is going on now.
So you have just explained the mindset of the offshore investors. And of course, part of the concerns that the CBN MPC also had during their media briefing as they spoke to us journalists after their MPC meeting. But are you trying to say as well that offshore investors are currently not very, very jittery? Because it looks like recently at the investors and exporter window, we had, for the very first time in 10 months, over 1.1 billion naira demand as against, I think, 303 billion naira. You know, so are you trying to say that offshore investors are not really jittery, as it were, right now?
Okay. Well, I don't want to use the word jittery because that could connote a different, like, fear in the market. There is no fear in the market.
Okay.
Where we are today in terms of our economy, we seem to be better off in terms of the economic fundamentals now than last year, this time last year. This time last year, we were in recession.
Yeah.
And when you are in recession, there is fear among all economic agents. They will not be able to spend. They won't, because they don't know what will happen next. But we are out of recession. Inflation this time last year was quite high, almost 17, 18%. Yeah. But we've now gotten to about 12%. 12%. I have forecast sometimes this for the month of March, 12%, 11% or about. We expect that we will likely get to single digits sometimes around July. So exchange rates is being very stable. So we are growing. The GDP, the number that Central Bank, the NBS released is positive. Still very fragile, but it's positive. And the growth is across so many other sectors now, you know, contrary to what we had this time last year. Yeah. So I don't want to say they are jittery. However, what we are saying is this, and we have moved from a yield of about 16, 17% on federal government bonds to the current level, 13%. Federal Treasury bill has moved downwards from about 22, 23% to 11%, giving room for private investors, private sector operators to borrow. Okay. But what I'm saying is this. You still have an economy that is dominated by one product, to supply foreign exchange. Yeah. So they need to manage all the various stakeholders in this instrument. Right. We don't run budget surplus as we speak. The deficit needs to come from somewhere. And that's what they are doing. Yes, you talked about demand.
Mr. Kimu, let's go on a short break. When we come back, we should continue this discussion. We'll be back in a moment and go away.